oil markets are getting a lift from a possible worst-case scenario on the Iran nuclear deal. The agreement reached in 2015 by Iran, the US, and other major powers expires on Saturday. US President Donald Trump has threatened to pull out if all parties don't fix what he calls its major flaws. And markets are expecting him to do just that, which means Iran could again face sanctions. Tehran has warned Trump against withdrawing and made some of its strongest statements yet on the dispute.
If the United States leaves the nuclear agreement, you will soon see that they will regret it, like never before in history.
The lifting of international sanctions on Iran helped the country re-enter the oil market as an exporter. But some Iranians say ordinary people have yet to see the benefits.
We do not feel any particular impact, especially in our economy or on our life. It is as if such a deal does not exist at all. What we are seeing is a lack of commitment from other signatories of the deal.
A no deal could result in less Iranian oil in the market and prices going even higher. Laila Humairah, TRT World.
Let's get more on this now with Stephen Schork, who joins us from Villanova, Pennsylvania. He's the editor of the Schork Report, which analyses the global energy market. Stephen, great to have you on Money Talks, as always. Do you see prices scaling the 2014 highs of around $100 a barrel, the last time they were above that mark?
I do think that is a limited, although it is a possibility. You never say never. We have to keep in mind that I think everyone is getting a little overexcited about oil at $70, $75 a barrel. We have to keep in mind we are putting that up relative to the last 3 years when oil prices were way too low. That is to say, too low to encourage investment into infrastructure to bring even more oil to the markets. Oil now at 70 to 75, even $80 a barrel, which is what Saudi Arabia is now telegraphing where it prefers to see oil prices, is not a level that is going to cause an extreme amount of heartache, economic heartache, to consumers around the world. Now, of course, to your point, could we go to $100? Well, of course, anything is possible, but we've seen a significant impact, or increase, I should say, in North American production, of course, out of the U.S. shale patch. And when we get to $100, and here's the just, when we look at the economics of it all, the consumer behavior, or to get technical, the inelasticity of demand, once you get oil prices above $100, you do run into an area where consumers will change their habits. And of course, the big deal and the big change over the past 10 years is consumers have the ability now to change their habits for the first time in history. And of course, I'm talking about the growth of electric vehicles. So there is economically a limit to how high oil prices could go.
When you look at the velocity of the increase, though, it is a fairly rapid rise from around $50 a barrel to where we are now. Could that velocity of change actually impact inflation numbers? I mean, you mentioned that consumers aren't likely to feel it right now, but that speed of change, surely that could start impacting inflation numbers.
No, absolutely. That's an excellent point. And of course, it certainly could impact, given to your point, the velocity of it all. And when we start to talk about inflation, now we get to talk about the U.S. Federal Reserve and their stance on interest rates and what that does to the potential dollar, the value of the dollar. And here's the interesting part. The strength in oil over the past 3-4 weeks has really been determined by geopolitical headlines. And this has occurred even as we've seen a nice rally in the dollar. Now, there is an inverse relationship between the value of the dollar and oil prices. So statistically, as the dollar increases, you would expect to see a pullback in commodity prices, given that the United States dollar is still, for the moment, the world's invoicing currency. So that said, we've had this rally despite the strength of the dollar. So when we go back to oil, this is a market currently being driven by headlines. A market that lives by the headline dies by the headline. So what we are seeing going into Saturday could simply be a case of, as they all say in Wall Street, you buy the rumor, you sell the fact. So we got a lot of people buying the rumor. Let's see if they sell the fact going into next week.
Well, so reading between the lines there, Stephen, what I'm seeing is that you're saying that demand is not necessarily where it should be to drive prices this far, this fast. Is that what you're saying?
Yeah, absolutely. When we look at, especially here in the United States, of course, with our large consumption, we actually have oil where it is being produced. Let's say in West Texas, it's trading at an extreme discount to even the New York Mercantile Exchange, which is the benchmark for North American oil. So we still have a glut of oil here in the United States, and we still have very strong demand. In fact, we have record demand for this part of the season for crude oil here in the United States. But that is still limiting the real price, the physical price of oil here in the US. And when we want to extrapolate that out, when we look at 10, 15 years ago, the US or the global consumer no longer is in the same position. They don't have to take oil at any given price. They do now, and that will continue weeks, months, years in ahead as we begin to switch over to electric vehicles. So that said, you keep a limit on prices to keep these substitutes relatively high.
Stephen, very quickly, do you see the shale producers then having the same kind of impact that they've had in the past?
Oh, tremendous, because what we've seen now with pricing now going out 2-3 years with oil prices in the high 60s, high 70s, this is mana for the U.S. shale producer. So they are hedging years of production out in advance and locking in their prices. So U.S. production is strong, and it's only going to get stronger over the next 2 years.
Stephen Schork of the Schork Report, thank you so much.